Get officially started so I can welcome you to today's webinar. This webinar is titled Three Strategies to Protect and Grow Your Retirement Nest Egg. Okay. Again, I appreciate you guys being here. If you're learning how to do that sounds good to you, now is a great time to turn off any and all distractions that you might have. If you got doors open, you got cell phones, I know you're not going to turn them off, put them on vibrate. Close any windows on your computer, and for the next hour or so, maybe we can stay focused. Take some notes. It is, well, it's 5 o'clock somewhere, right? Maybe you got an adult beverage sitting on your desktop. That's all good, but I'm looking forward to the next hour. We want to stay focused. Let me quickly introduce myself. I see a couple of familiar names in the chat box, but my name's Jim Penna. I'm the manager of retirement services here at VectorVest, and I've been here for about 14 years now at VectorVest, and it's been a great run. Again, as I mentioned, I'm from Connecticut, Stamford, Norwalk area, and moved down here about 16 years ago to just north of Charlotte. We are in Cornelius, and it's been a great run here at VectorVest. Prior to that, back home, I worked on a trading desk. I was a market maker for a large firm for a while. Before that, I worked on some smaller trading desks. And as I mentioned 2 lifetimes ago, I was a police officer in my hometown in Norwalk, Connecticut. So that's kind of my background. I took my Series 7 and got into the business back in 1992. So it's been a long time. Right. Paul says sound is breaking up a little. Paul, I don't see anyone else commenting on that, but maybe I'll try to make sure that everything's in order on this side. Okay. All right. So let's get right into this. So what we're going to talk about today again is building and managing your retirement portfolio. I'm going to focus on three core strategies. Okay, three core strategies that we use so that you can build and manage your retirement portfolio. It kind of all began with, well, didn't begin with this, but this was a great quote that I had found for what we do here, and it's from Mark Twain, again a fellow Connecticut Yankee, Thomas. He said, "Don't just sit there and worry. Be proactive. Do something, anything about what's worrying you." Okay, so that you can gain information, focus, and control over the situation. He says, "I've suffered a great many catastrophes in my life. Most of them never happened." And so it's a great quote because it kind of leads in and segues into a lot of the things we're going to talk about. So don't just sit there and worry. You can be prepared and know what to do. Be proactive. And so we don't want to be, the owner of this boat here who has no worries and thinks everything's going to be all right all the time, because that's what happens when either when you just worry or you're not proactive. Okay. We have what we call the ultimate retirement solution, is what we're going to talk about. And it comes from a conversation that I had with our founder and mentor, Dr. Bart Diliddo, several more than a few years ago. And we were talking about the question that comes up in some form or fashion when we'd be on the road talking to our customers and clients. Or the question would always come up: how do I keep from running out of money in retirement? Okay, how do I do that? Well, after talking with Dr. D and discussing it, he said to me in a way that only I know that Dr. D can. He said, "Well, James, just tell him to keep making more money. Just keep making more money." And so that's really our ultimate retirement solution, and that's what we want to talk about. So that solution is that our job or our goal here is to convince you that you can retire with peace of mind, knowing that you can steadily grow your portfolio, that you can generate a safe, steady income, and that you can preserve your capital. Okay. We believe that a secure retirement is one in which you have enough income to live the life that you desire. Now, even if it's not the old cliche of buying a new sailboat and floating around the world, that's okay. As you can see, these VectorVest customers name their boat the VectorVest. So, but it's the retirement that you desire that we're looking to achieve here, where work is optional and retirement is affordable. Okay. So here is here's our setup for the day. Remember, I said we want you to retire with that peace of mind. And so we have the three core strategies, and we put them under this umbrella. We say we want to be able to profit, provide, and preserve. And what do we mean by that? Well, let's start with profit. Profit has to do with growing your retirement nest egg through capital appreciation, buying the right stocks at the right time so that your portfolio doesn't end up like a roller coaster where you never know where it's going to be. Now, listen, every investment plan, you're always going to have some drawdown. Nothing's going to go straight up, but we're looking at the very least for that steady climb. You know, we don't want the volatility and the unpreparedness to get the better of us. Next, we look at provide. Here we're talking about income, generating a safe, steady income in retirement where you just don't have a few random dividend stocks that where a dividend now and then trickles in. Okay, we have what we want you to have is that steady flow. Okay, we want to have a nice steady flow of a safe income, and that's the second part of our core strategy. That's our second core strategy. And then finally, preservation of capital, which you'll hear me say more than a few times throughout this presentation, that this to me is the most important part of growing and managing your retirement, your net worth, right? Preparing your net worth. We want you to go from being unprepared and know exactly what to do when the market does move against you. So it's very important to know when to strategically become defensive in your portfolio. So that's a kind of a synopsis of the three core strategies. I'm going to get into those in much more detail. But as I'll ask throughout the course of the presentation to interact, make sure you guys are here with me and we're on the same page. And my screen is blinking, and I know a couple of people have typed in about maybe the sound. I'm not sure exactly what's going on, but every once in a while I have seen my screen blink a little bit. It's the beauty of live entertainment, right? So we'll power through it. Okay, so the question is, what's the hardest part about preparing for retirement, or if you're already in retirement, just so I can get a sense to see where we're at and what we want to talk about today. All right, good. Andy says the sound is good. All right, great. So FB will say says yeah, when and what to buy and sell. Yeah, in a nutshell, that's really the whole idea of building and manage. You're going to hear me say, I can't say build a portfolio anymore or manage a portfolio. To me, it's all one word now. You, you have to have the process, the system to build and manage your portfolio. And yeah, knowing when to buy and when to sell is basically the process. Yeah, Claude says having a plan. And a lot of what we're going to talk about is having that system in place. Yep, Santosh says which stocks. Yeah, the what to buy is one step. That's the building part. Right? We're going to build and manage. So, yeah, from what I'm seeing come across, I can't comment on all of them, but because they're coming in. Yeah, Stephen, there's a good one. Generating income in low bond interest rate environment. Well, from what I'm seeing, you guys are in the right place. Stephen, you're in the right place as well. So let's go ahead and go into the three strategies. We'll talk about them one at a time. And we will be able, Kurt, to navigate these uncertain times. So let's start here. Again, we talked about profit. That's capital appreciation, simply growing a portion of your retirement nest egg, your net worth, by finding the right stocks at the right time and watching your portfolio grow. Next is income. Okay, there are actually two parts to the income core strategy. And we're going to talk about it as we go through. It's going to be both from good quality dividend growth stocks, and it's also going to be from the power of understanding how to sell covered calls against positions that either you own or doing what's called a buy right. But we'll get deeper into that. And then finally, the capital preservation. Okay, and I've got some good examples on the importance of capital appreciation for you today. Let's start here with capital appreciation, and we'll talk about the profit. Now, capital appreciation comes from owning companies with consistent and predictable financial performance. Okay? And what I often say is, what two better adjectives to describe the type of stocks that are in your retirement portfolio than consistent and predictable? So with that, what Dr. D has written and said many times is that good portfolio management starts with buying the right stocks. And as I'll do throughout the presentation, I'll use some baseball analogies. I played ball a long time ago in college. My favorite team growing up was the New York Mets, and I apologize to any potential Chicago Cub fans for what happened to your guys in the '69 season. But the idea here is building your portfolio is just like putting a winning team on the field, right? Good portfolio management starts with buying the right stocks. If you're the man, think of it as a manager or general manager of a sports team, right? If you got a guy like Tom Seaver on the mound, right? That's that's putting good stocks in your portfolio, and that's the idea there. So Claude says, "Let's go Mets." Yes, definitely. But that's the idea. It's like you're the manager of a team. Think of it that way. I have to put the best players on the field or on the ice or on the court to make sure that my portfolio does what we need it to. And a lot of that all comes down to safety first. In other words, for our retirement account, primarily our growth portfolio, we want to look at a company's safety more so than anything else. Because to keep the baseball analogy going, while it's fun to hit the home run, as we know, what happens to most home run hitters when they don't hit a home run? Right? Usually they end up striking out. And that's not what we want in our retirement portfolio. Okay, that's not what we're looking for. So we're not looking to buy the stock for a buck and a quarter and have it go to 20 bucks. That's not what we're about here today. So when we find these quality stocks, consistent and predictable financial performance, what we find that these stocks have in common is that they pass this stock safety checklist. Now, these are the factors that go into an indicator of risk in the VectorVest program called relative safety. And Dr. Diliddo created a formula where he took information, right, data about companies, balance sheet stuff, and put it through a funnel through his algorithms and created the VectorVest parameter called relative safety. And those pieces of information were the earnings consistency, company size, price behavior, business longevity, dividend history was a big part of it. Now, keep in mind, a company doesn't have to pay a dividend to be considered a safe company. But as we'll focus on when we get to dividends, if the company does pay a dividend, it darn well better always pay its dividend and continue to grow it. Otherwise, it'll hurt the company and hurt the stock. And then finally, debt to equity ratio, and we'll talk about that as well. So those are the key pieces of information on the checklist that we want to check off. Now you can go out and manually try to find information on stocks like this. I guarantee you when you do, you will get buried by the data by manually trying to do this, but you certainly could. So again, what we've done here at VectorVest is create this one single indicator that looks at all of that information. And again, it's called relative safety, or RS, in our program. Okay? And it's based on the consistency and predictability of the financial performance of the company. Okay, so when we look at stocks, when we're able to check these boxes off, here's just one example of a stock that meets that criteria. Now, I took this screenshot yesterday. This as of yesterday. WST, West Pharmaceuticals, has a relative safety indicator in the VectorVest program of 1.46. That's on a 0 to 2 scale, and it is considered anything 1.4 or greater is considered excellent. So West Pharmaceuticals. And you can see down here, now I have a 5-year graph up here to give you an indication of what we're looking at when we talk about safety. So here's a company that's grown its earnings. Right? The VectorVest earnings are a combination of historical and forward-looking numbers. And so when you see a company continuing to grow their earnings, it's not coincidence that the stock also has a nice, what I call a northeasterly direction here on the chart pattern. And if that doesn't look like much of a move, remember these are $50 increments on the graph here. So that's a stock that's moved very nicely based on its earnings. Now we also talked about dividends, and West Pharmaceuticals also happens to be a good illustration when we talk about dividend payouts as well. So here's a company that is making money quarter over quarter, year over year. Their stock price is moving nicely, and their dividend continues to grow. What I refer to as the golden staircase. They continue to grow that dividend. Now, West Pharmaceuticals happens to be what's called a dividend aristocrat, where they've grown their dividend over 25 years or more. Okay, and I'll talk more about that in a bit. But that's what we're looking for when we talk about dividend history, price behavior, earnings consistency. That's what these good quality stocks all have in common. We talk a little bit about debt to equity ratio. I won't go through the textbook definition of it here, but just know that a good debt to equity ratio for a company is very important, and it's part of the calculation here, because what it does is it allows a company to be able to weather any type of headwinds that might come in the market, right? Just like we've seen in that we're seeing now, right? The companies that are better prepared for it are gonna work out better over the long term. So very important, the debt to equity ratio. And I think I just lost my screen there. All right. Yep, something's definitely going on in this end. Stay with me 1 second. Let's see if we can get our PowerPoint back up and running. Warren's asking, is WST a buy today? Warren, I didn't actually look at the stock today, so I'm not 100% sure. If the VectorVest program is giving it a buy rating, I'm not sure. So let's see. Making some headway on this side. Be patient with me. Let's go there. All right. My screen is back up, and I'm getting right back to where I need to be here. So there we go. All right. You guys should be able to see my screen back here. Okay, sorry about that. So anyway, the debt to equity ratio is important so that it can get through any type of headwinds that we're seeing now. The stronger companies with that favorable debt to equity ratio will perform better. Now we have in the VectorVest program, what I have here, we have what's called the Unisearch tool, and just because a couple of folks had typed in, how to find the right stocks, what stocks to buy, and this is just one example. It happens to be my favorite search within the program, and it's called ruler stocks. And you can see that the parameters just to make the list, or when we run the search, to make the list on the search, the company has to have a relative safety number of at least 1.4. Again, which is excellent on the scale for our proprietary parameters. So, and the earnings growth rate has to be at least 14%. And you'll see a lot of familiar names here, good quality companies. That's what we look for when we talk about capital appreciation. And just real quick, why are they called ruler stocks? Well, not that ruler stocks is the only search where you could find high RS good quality searches, but it is a great one, and they all kind of fall under the umbrella of ruler stocks. It's an old name given because what happens is, whether it's earnings per share or the price of the stock, right? The idea is that you can draw this straight line on a ruler on the upswing. We know nothing goes straight up, of course, but that's the idea behind ruler stocks. So that's why they call them that. So consistent, predictable earnings, quarter over quarter, year over year. How long has the company been around? Obviously, a company like West Pharmaceuticals has been around. Again, they've grown their dividend for over 25 years, and there's a lot of stocks like it. When we put together a growth portfolio focused on these type of stocks, and we employ the proper investment plan or process behind it, here's just a quick peek at the type of returns and the type of success that we've had. So we're looking at a ruler stock portfolio. It says 3+ years because it began in January of 2017. I began tracking and trading in this portfolio. So it's just a little over 3.5 years old at this point. So that's why it's the 3+. Currently, we have a full roster of stocks in this portfolio. And you can see that the overall gain is 120% over that three and a half, just about 3.8 years, I guess. Okay. Now, that's a 33.36% annualized rate of return. These flat lines mean we went to cash based on our trading system. Yes, there was some drawdown in the sell-offs that you remember. I don't know for folks. I know it seems like an eternity ago, but October of 2018 had a huge, very sharp sell-off. Not quite as big as the recent one, but we do have ways to mitigate that. I'll talk about that later. But even with that drawdown, percentage is still up over 33%. Okay. Now, for those curious as to how that has performed against the S&P 500, I ran a quick test from the same date. This all went right up to yesterday. The S&P 500 is up 13.73% or 49% overall versus our 120. So we've almost, not quite, almost tripled the performance of the S&P 500. Okay. So that's the power of understanding when and what stocks to buy and when. And so it leads to the question for our first core strategy about capital appreciation. And again, you can type in, we all know the answers, but again, I like to interact. So would you rather have the safety factor in your favor and avoid the roller coaster ride? Or would you rather have the steady climb? And I just chose the one stock here. There's dozens I could have found, but I used West Pharmaceutical, right? And thanks. Yeah, Joe, first one in, says safety. Of course, John says safety. Yeah, and a lot of folks are typing in. And of course, again, I just want you guys to interact. But yeah, I'd much rather see my stocks and thereby my portfolio have this kind of move to the upside. Okay. So that's our first core strategy. That's the importance of finding the right stocks at the right time. Next, I'm going to talk about income. Okay, we're going to talk about generating a safe, steady income. So we switch gears here. We look for some different characteristics in the underlying stocks that we're going to talk about and understand there are two parts to the income strategy. There are two parts to it. So let's start with part number one. Okay, we're talking about provide. We want steady income flow from both dividends and covered calls. Let's start with dividends. Right. The goal here is to get paid. Right. The objective is a safe, steady cash flow as I approach or I'm in retirement. That's our goal here. Now, just like I said earlier, you can go do research and you'll get buried by data. What will happen if you Google good dividend stocks, everything you find will simply sort by the current dividend yield, as if that's the only indication of whether or not it's a quality dividend growth stock or ETF, whatever it might be. Okay, that's just not the way we do it or the way we want to do it. NASDAQ has a post, and you'll see again, 32% yield on a $4 REIT. And it's the same idea wherever you look. So here's how we do it at VectorVest. We have a couple of different ways to find good quality stocks. What I have up here now is a screenshot. Again, this is right from yesterday. What's called the DRIP 25 Plus. We have a watch list section in our program. Under dividend payers, we have several. I'm going to focus really just on the DRIP watch list here. It stands for Dividend Reinvestment Plan. So all of these companies, like most now who pay a dividend, right through your broker, you can reinvest that dividend to take advantage of the compounding of those dividends. And this particular list is 25 plus. These are stocks that have not only paid but have grown their dividend over the past 25 years or longer. And Lowe's comes right to the top. They just had some good earnings. I own this in one of my retirement accounts. And you see a nice high relative safety. West Pharmaceuticals next, right here at on this list. Sherwin-Williams, T. Rowe Price, another stock I like a lot. I'm going to show a graph of that one in a minute. How do we find those? Well, we go into the Unisearch tool, and again, this is not the only search, but there are several ways to find good quality dividend-paying stocks. One search that I created is called the Blue Chip Dividend Payers, and it is very basic. All we do is take Dow Industrial, Transports, or Utilities, or the S&P 500. To make the list, the dividend yield has to be at least 3%. I only want stocks who have paid or grown their dividend for at least the DRIP 25 plus, or we'll take the 10 to 24 list. So in other words, at least 10 years, they've not only paid but have grown their dividend. And then finally, dividend safety. Now, dividend safety in the VectorVest program is the only indicator that's not on a 0 to 2 scale. It's on a 0 to 99 scale. And the reason dividend safety is important is anything greater than 50 tells us that the dividend payout ratio is favorable. And what I mean by favorable is that the earnings per share is greater than the dividend paid, or the earnings yield is greater than the dividend yield, whichever metric you want to use. Right? We just want to be sure the company's not paying out more money than it's making. And so dividend safety of greater than 50 is a great indicator to do that. I mentioned T. Rowe Price. Now here I did pull up an actual 25-year graph. That's how far we can go back in the VectorVest program. That's how long we've been around, actually more than 25 years. And I mentioned earlier that golden staircase, and this is a much better visual of what I was talking about. That dividend has been paid and grown year over year. You can see a good one of the reasons is because they've got steady earnings, and so that stock price. And again, like I said, nothing goes straight up. And all of these big moves on these quality stocks can be equated to the current market condition. This is 2008. This is late 2018, and this is February of 2019. So we all know what happened during those time frames. So again, a good quality stock pays a nice dividend, safe dividend, and a growing dividend. So that's what we look for. Now, when we talk about building a portfolio to provide income with dividend growth stocks, again, here's the when we do it right with the proper trading system, here's some of the results that we can expect. Now, this blue chip dividend payers portfolio is a little bit longer than the 3.5 years because it is a longer term look that we want to have in place. I began this model portfolio several years ago. It was created kind of as a model, as a back test. That's why it's 7 plus now. It's about 7.5 years. But back then it started at 3 years, and then I just kept it going. Using the blue chip dividend payer search, these are the stocks that we currently have. That's 118% in about 7.5 years. That's 15, just under 16% annualized rate of return. Pretty good over a long period of time. And again, as I did with the other stocks, I compared it to the S&P 500, where the S&P actually did perform slightly better. However, what this equity curve here does not take into account is the over $33,000 in dividends we've received over the life of this portfolio. Now, it's not recognized here in the equity curve. I went and created a spreadsheet and calculated for the life of each trade the dividends that we would receive, and it's over $33,000 at this point. So that's not reflected there. So when you add that 33,000 to the 118 we're already up, you've got an annualized rate of return now that handily beats the S&P 500. And to take it one step further, that number doesn't even take into account the compounding of the dividends that we receive. That just assumes we just left it in there in cash or withdrew it, which is okay. But if you were reinvesting these, this number would be even greater. I admiringly call this a very boring portfolio. That's why it's one of my favorites. We get the benefit of both capital appreciation and dividends without a lot of trading going into it. And again, I'll talk before we're done here today about these drawdowns and how we are strategically in place to protect and mitigate those drawdowns. Maybe not dollar for dollar, but to never really suffer that huge move there without being proactive in some way. Okay. So that's part one of core strategy number 2, a great way to generate safe, steady income in your portfolio. Okay. So we're going to stay on income for just a second. We're still under provide, and this we're going to talk about now is part 2 of generating safe and steady income. What I'm going to talk about now are covered call options. Selling stock against I'm sorry, selling call options against stocks that you either already own or selling a call against a stock you simultaneously purchase. Before I go any further, this is about our retirement. What I and I don't know, and it's a fairly large room. I don't know who trades options or has experience in options, but what I don't want you to do is look at this and say, well, there's options involved. I can't do this. I've been doing this a long time. I'm going to talk about two option trades today, both of which I believe are a necessity if you're here because you're building and managing your own retirement portfolio. Your net worth is going to be based on either one or both of these option trades that I'm going to talk about if you're going to manage it. So if the covered call option is a income option trade, it is the most basic income trade there is. Right? If you understand buying a stock and selling a stock, you'll understand the concept of a covered call. You do not have to be an expert in options to trade a covered call, to sell a covered call. Okay. All right. So I just want to be clear on that. That this is not, you don't need to, whether you're brand new to options or you've been trading options for 30 years, covered call is not only one of the most basic income trades, it is the most popular income trade there is as well. So let me explain it to you. How do we provide income with covered calls? Here's the way I like to look at it. Okay, and Maurice, again, if you don't have experience with options, stay with me because by the time I'm done in the next 5 minutes, you're going to understand everything you need to know about a covered call. That's my promise to you. Okay. Um, Look at it this way. You want to what selling a covered call is basically is you collecting rent on the stocks that live in your portfolio. Think of it that way. Okay. It is an excellent way to generate income, and this is a great definition. Not only a definition, but the logic and reasoning behind why you should be selling covered calls. But the highlighted portion in green here, I just think is the most straightforward, logical definition that I know of. So I borrowed it from a gentleman named Mr. Lee Lowell, an options trader, wrote a book called Get Rich with Options. If you own shares of stock, and it's got to be at least 100 shares, and you're not selling options against them, you're throwing away free money. And he goes on to define the trade. Here's what a covered call is. There are other traders out there who will give you money today for the right to take your stock away from you if it reaches a much higher price. Selling covered calls is such a great way to pad your bank account. I still can't believe there are investors who aren't taking advantage of it. And frankly, neither can I. Okay. Someone's willing to pay you to take your stock away at a higher price. They do that by entering into a contract. A call option gives the buyer of the call the right to buy 100 shares, a minimum of 100 shares, at a certain price by a certain date. Okay. The seller of that call option is obligated to provide the stock, but for that obligation, he gets paid. And let me explain that to you. So here's the basic definition. What's called a buy right, when you buy the stock and sell or write the call contract, they're synonymous, selling or writing. When you buy the stock and then simultaneously sell the call option against it, it's known as a buy right. Of course, you can also sell one option against every 100 shares of stock that you already own. Okay, you enter into a contract and you get paid. And the term covered comes from the fact that you own the stock. So if somebody exercises their right to buy the stock at a higher price, they're just going to call it away from you, which is great because it means you made money. It means you made more money. Let me break it down quickly here in a theoretical trade. This is what a buy right, or it could just be a regular covered call as well. In our theoretical example, I go out and I buy 100 shares of XYZ and I pay $60 per share. Okay. I then sell one XYZ covered call option with 45 days to expiration at a strike price of $62.50. Well, what does that mean? Remember, it's a contract with strictly defined terms and conditions. That's what an option is. In this case, those strictly defined terms and condition are the expiration date and the strike price, the price at which you strike the deal, that the buyer of this call can take away your stock. And they have 45 days to decide if that's what they want to do. Right? So somebody paid me $2 per share to take away my XYZ at 62.50 per share. Paid me $2, which means I now own the stock at $58. That's my net debit for, or 5,800 for 100 shares, or what's also called the break-even point. Right? My cost basis or break-even; those are also synonymous. At expiration, so what we'll do now is talk about some what-if scenarios. So what happens at expiration if XYZ is above 62.50? So XYZ does what I hoped and wanted it to do. It went higher. Right? It went to maybe, I don't know, 65 or 66. What happens? Well, at expiration, my stock will be called away by the trader who paid me $2 to take my stock at 62.50, which is great. It means I reached my max profit, and I'm very happy about that. So at 62.50 minus my $58 cost basis means I made $4.50 per share, or 7.5% return on my investment in just 45 days. Remember, what we're doing here in this core strategy, the objective, always remember the objective of the trade you're entering into. The objective of this trade was to capture as much of that $4.50 as we possibly could. I don't care if the stock goes to $90 a share. It wasn't my objective going into the trade. Now, what happens if XYZ is below 62.50 at expiration? Well, remember, we took in that $2 per share, which is actually 3.3% lower than the original price. Right? That was the initial cash yield we made by selling the call, which made our cost basis 58. What it's also referred to as a cushion. So XYZ could actually go down from 60 as long as it stayed at or above 58, we'd still make money on our covered call option. So there's a cushion built in. Now, if XYZ is below 58 at expiration, losses will occur. Remember, the risk in a covered call does not come from selling the call option. There is no added risk at all to selling a call option to your position. The risk is inherent in the fact that you own the stock. And there are very specific trade management techniques that we employ here for the covered call. Okay, so that's the anatomy, that's the breakdown. What I've done is put it on a graph, and I'll walk through it again. It's the same idea, so I'll walk through this just so you can see it on a graph form. Don't worry about the dates or whatever. It's the concept I want you to take away. So you own or buy 100 shares of stock, right? Let's say you own 100 shares of Dollar General at $112 per share. I decide I want to sell somebody the right to take away my stock at a higher price at a later date. So I sell what's called an out of the money strike, right? The strike price is above what I paid for the stock price. And all that means is I have some capital appreciation potential here, right? They paid me to take it away at a higher price. They paid me $2.65 a share, or $265 for a contract. Okay, so that's the scenario. That's what I did. And again, as I did on the previous slide, if the stock goes, the what if scenarios, if the stock goes down, we have a cushion there, the $262.65 cushion. It'll help to minimize. If the stock stays above that and just kind of goes sideways, we make money because we get to keep the premium we received, and then we can decide I can go and just sell another covered call against it and continue to generate income and lower my cost basis. And then, of course, if the stock goes up, we can make what's called the max profit. Remember, your profit is capped when you sell a covered call. Many will feel as though that's the disadvantage of selling covered calls. And I just vehemently disagree with that, because if my objective was to capture a predetermined amount of money, I don't care if the stock doubles in price. It wasn't my objective when I placed the trade. So in this case, at expiration, the stock actually went up to $119. I would have made $300 in capital appreciation plus the 265, and I would have walked away with 565 bucks in about a 30-day span. That's how the covered call works. Now, we have a retirement coaching group that meets every Tuesday, and we have a specific process that we go through. And this is just one example of how you can steadily generate income on an underlying stock. Now, I won't go through every specific scenario here, but in that portfolio, this is just a little over a year. This goes back to June of 19. What are we in? We're in August of 20. So a little over a year, we actually made these trades in our portfolio. 6.8% return in 31 days, another 7.5% in 28 days. So what we did was buy the stock and sell the right for somebody to take it away. And this is our income portfolio. This is just one stock. We have other trades as well. This led us right up to the sell-off. This is February of this year. We closed another trade that you don't see here right before the sell-off. And then in 2020, after the sell-off and when the market was favorable, we did 3 more AMD trades that were all winners as well. Okay, so that's the beauty of the. I'll even show you the spreadsheet. I'll show it to you now. This is the trades we've done in 2020. 15 winning trades out of 18 round trip trades. We have 4 profitable trades that are open right now. You can see AMD is on here, at least 3 round trip trades. These are in addition to the ones I just showed you. 538, we made another 616, and then we made, what was that one? 894. Okay, 83% winning trades following the system, generating income. Generating income. Robert says, so you were never called away. No, Robert, our trading plan had us, our trade management technique had us out usually before the expiration when we would be called away. So these prices are not at expiration. Okay. So that's the power of selling covered calls when you do it right, when you have a process and a plan in place, finding the right stock, and that's just step one. Then you have to find um, the right underlying, and then the best option candidate, and then you have to have the trade management in place. Okay, so we generally go out 30 to 45 days is our expiration, and we're usually 1 or 2 strikes out of the money. So we're usually selling a delta. For those who do trade options and are looking for the option jargon, I try to stay away from it because I know probably a lot of folks are not option traders here, maybe or maybe not. But you generally be selling a delta anywhere between the low mid 30s up to maybe 40 or 45. So you're always going to be selling out of the money in our process. Okay, just another great way to generate a safe, steady income in your portfolio. Finally, we come to capital appreciation, I'm sorry, I misspoke. Capital preservation. Capital preservation. I often joke that I took the oath to protect and serve, what seems like 100 years ago now, and I still live by it when it comes to talking about your net worth and your retirement portfolios. Right? We want to protect. There's a great excuse me, a great quote by the hedge fund manager Ray Dalio. Hopefully you know who that is. And he once said, and I'll paraphrase a little bit, he said, you cannot make money in the market without taking risk. And you certainly cannot keep the money you make without being defensive. Okay, so what we're going to talk about is that defensive portion of it right now. And what we're going to talk about are protective puts. Okay. Again, for those who may not be familiar with options, a put option gives the buyer the right to sell a stock at a certain price by a certain date. If you're long a put, it is technically a bearish bias. I want you to think of it as an insurance policy. We're talking about protective puts to protect an asset that you already own. And it comes in handy when we go back to Mark Twain's quote, when I'm worried, when there's a reason to be strategically defensive in my portfolio, I'm not just going to sit there and say, boy, I hope my stock doesn't go down. I'm going to be proactive. I'm going to do something, and not just anything. In this case, I'm going to buy a protective put. So in other words, our goal is to protect your assets. All right. So the goal, of course, the objective here is to reduce risk. That's what put options are going to do for us in this case, for this objective. So we buy put options to protect individual stock positions, or you can do it for your entire portfolio. A protective put is an insurance policy on an asset that you own. You can also use what's called option collars. I'm not going to illustrate those here, but it really is just a combination of the covered call and a protective put. But we're going to focus on the put option. You insure your home, your car, your life, your health. Heck, my wife and I have insurance on our 2 dogs. Right, so it only makes sense that you would want to make sure your portfolio and your stocks are protected just in case something happens to them. Okay, and that's what buying the call option is all about. Let's take a look and try to understand the basic concept of a put option. Again, disregard the time frame. It's the Texas Instruments, and for this period of time, the stock just took off like a bird. Right? These are confirmed call signals in the VectorVest program, and the stock both times was looking very strong there. So if I bought the stock, whether it was during this, for our purposes, this will be the confirmed call where we actually bought the stock at just under $100 a share. Maybe you bought it way back here or somewhere in this range. Either way, you have a stock that did exactly what you expected it to do. You bought it at the right time and it went up. In this case, it went up significantly. But we're going to look for those strategic reasons to be defensive and protect that put. Because the state of mind I want you to have when you're looking at protecting an individual stock or your portfolio is this. Okay, yeah, I bought the stock at 98, 99, whatever it was. I understand that that's my cost basis. The mindset I want you to have is that that's not really where I own the stock. I own it here now. That's, even though it's an unrealized gain, that's my money, it's my stock, and it's incumbent upon me not to give that back. Or at least, and again, we know nothing goes straight up, but at least not anything significant of that unrealized gain that I have. It's my job to protect it. And if I don't, it's my fault that I didn't. Okay, so that's the idea. You're protecting an asset. Now, when you buy a put option on the underlying stock, the price of that insurance policy is going to depend on where you set the strike price, and that's up to you. You make that decision. Now, with the stock trading at 120, I can buy what's called the at-the-money put option and buy the right to sell my stock at $120. If the stock falls, the value of my put option will rise in price, thereby offsetting the loss, right? If my property or my asset is damaged, the insurance policy will cover the damage. So I can pay more for a good insurance policy and buy what's called the at the money, or I could buy a less expensive insurance policy and buy what's called an out of the money put. So with the stock trading at 120, I could say, all right, I could take a little drawdown, no big deal, but if it goes below 115, I want to start to insure that asset. That's how it works. Okay, so that's kind of the setup. Let's go ahead and look at the case study and see exactly how this would work out. So again, we bought the stock here. We paid, I don't know, just under $100 for it during the confirmed up because it was a good quality stock. Because we do our due diligence on every position we own, we know that we have earnings coming up, right? And this is a couple of months, 2 or 3 months later, we've got a 20% gain, roughly, which is about $2,000 on the stock. Right? I now have roughly a $12,000 asset that I need to protect. So again, we do our due diligence. We know earnings is coming up. Usually the window to react or to be proactive is about a week to 10 days. You don't want to do it too early. And listen, if you have to do it a couple of days because you missed the date or just didn't see it coming, that's okay. But roughly a week to 10 days, we're going to go out. So 1 week prior to earnings, I want to protect this wonderful profit that I've created in my portfolio. So in this scenario, I'm going to use the more expensive or the at the money put. I'm going to pay $4.23 per share, or 423 bucks, to insure my $12,000 asset for a very specific reason, because earnings are coming out. Earnings come out a trading week later, and what happened? In this case, Texas Instruments either had bad earnings or bad guidance or whatever it was, but the stock gapped down all the way down below 110 it traded. Right? So what happened? Well, as I said, the put option increases in value, which offsets the damage to my asset, to my property, whatever you want to call it. Right? So my put option is now worth $1,128, which is just over $700 profit on the put. Okay? So that's how my insurance policy works. So what does it look like? Had I not bought insurance, I still had a gain. But again, to me, I lost $1,000 because I did nothing. $1,000 of my profit is gone. But because I bought the insurance policy, I was able to profit from the insurance policy, and now my loss is only $300. I mitigated the drawdown. Remember in the graphs that those sharp, violent drawdowns, I said we mitigate those. And this is one way we do it. Right? So, I'm sorry. So instead of losing half of that profit, I give back just a fraction of it. Okay, that's an illustration of the power of buying insurance, and in this case for an individual stock. Now, let me ask you while I take a quick sip of water, because I got to take a quick sip. Would you rather have no insurance or protection on your portfolio, on your assets, or would you rather understand the concept of buying a protective put and be able to sleep better at night the day before an earnings report? I'll let you guys answer that. I got to take a quick sip, sneeze too. And yes, okay, great. Everyone's answering. And again, we all know the answer, but I like to interact because then there are some good questions, and I'll address these in just 2 seconds and keep moving here. Warren says, "What about the $423 cost?" Yes, Warren, we did pay money for an insurance policy, and what would have happened is we've taken into account that $423. By the way, if that's what you're asking, I'm sorry. Right, we profited $700. We bought it at 423. The value was roughly 11. It was 1128. So we profited by $700. That includes the cost. Okay, and then the next, I see somebody asking the question, and they're coming through quickly. Annie, I think. What if the stock goes up? And that's the common question that we get. Well, if the stock gapped up instead of down, what I would have done is sold my call option. I'm sorry, my put option, and I would have lost some money on it. I bought it at 423 or 423 bucks. If the stock gapped up 5 or 6 points, I probably would have lost at least half of that 423, maybe even a touch more. But remember, it's an insurance policy. It's protecting your $12,000 asset. I'm more than happy to lose $200 or $300 and not lose $3,000 or $4,000 or whatever it might be on my underlying position. So the analogy I use is my car insurance, for instance. Right? I use Geico. On the 18th of every month, they automatically withdraw my insurance premium and take it away from me. Right? Cost me money every month. Now, when I look at my bank statement and I see that withdrawal, I don't get mad. I'm not angry that I didn't, smash my car up or a tree didn't fall on it. Right? That's the outlook I want you to have on the insurance policy. Right? I'm glad I didn't total my car this month. So that's the way we want to do it. All right. Terry, yeah, I'll get to that. Terry's saying were protective puts sold on the portfolios that you highlighted earlier. The answer is yes, they were. And so we were able to, again, mitigate, not dollar for dollar, but we cut fairly fairly nicely into the drawdown that we had there. Okay, so that's an important concept. Now, I want to get to the idea of the case study for your overall portfolio because, yeah, if you want to go out, you want to do your due diligence, protect on earnings reports. And what you can also do, and there are strategic times to be defensive for your overall portfolio. And instead of going to each individual stock, let's say during a confirmed down call in the VectorVest program, in other words, a signal that the market trend is turning and there's reason to worry. Okay, so let's talk about a case study on this. Again, we're talking about capital preservation. This time, I'm going to talk about the S&P 500 and using put options on the SPY, which is the ETF that tracks the S&P 500. So the story behind this slide is I created this slide for a presentation before the pandemic hit and before the sell-off came. And the point I was making in the presentation is that, yes, this market is on a tear and it's going up, but you cannot look at this and just believe that the market is never going to peak, it's never going to turn over, and we look for, again, specific reasons to be defensive. So what I was saying in that presentation is that don't tell me about this move to the upside without remembering what happened here. And I know in this day and age, October of 2018 is an eternity, right? In this day and age. But it's not that long ago. Okay. And remember, this was before all of the pandemic sell-off. So um, here's what happened in 2018. Right. We had a very nice run up in the market, and the market 20% it fell in 90 days. It fell over almost 20%. A bear market it sent us into. Right. It took. Now it did break above that, and you can argue that it went, but I say it took about a year to make your money back before the next rally in the market came. So if you'd done nothing, remember, if you lose 50% of your portfolio has to double. It has to go up 100% just to get back to even. The whole purpose of going through this is that you need to be protective. You need to be proactive in your portfolio. And there are certain times when you need to do that. So I'm using the same graph. I'm zooming in on this a little bit. So now I'm going to focus on this year, this February, when mayhem hit. Okay, so I zoomed in here a bit. I'll zoom in even one more time. How do I know? Knowing when to initiate the insurance is actually pretty easy through VectorVest. And when we saw the DEW timing system, right? For those, if you're not a subscriber, it's a prudent timing system. We have up and down signals as good times to either become defensive or to enter into the market for a DEW up. But on February 24th, just 3 trading days after the all-time high that we hit on the SPY at that time, the VectorVest program signaled it's time to be defensive. We could protect our portfolio by buying SPY puts. 4 days later, the confirm call went down. So if you didn't heed the DEW, you darn well should have at least used the confirm down. Right? Become defensive. Buy puts on your portfolio. Zoom in one more time. Same time frame. Here's the DEW down. Okay? So here's the scenario. The DEW goes down. It's a good time to place a protective put. For our illustration here, I'm saying I'm going to go out and buy one at the money put option. It gives me the right to sell 100 shares of SPY at $322 per share. Theoretically, a $32,000 insurance policy if SPY ever went to zero. It cost me $9.75 or $975 to buy one option to help insure my overall portfolio. Okay. This is the scenario. Be defensive, be proactive, do something. Okay. Now, not even a month later, on March 13th, that April 322 put option is now worth $71 per share. Now, I'm not saying, well, I can say you should have bought it somewhere right here, either here or here. I'm not saying you would have held it right to the bottom, and that's why I even picked the next day when the market did spike up. But if you had purchased that, and even if you sold it anywhere in this range, you would have made some very nice profits on your put option to help mitigate the loss in your portfolio. Okay, that's the DEW. I do the same thing, and I'll just walk through this because it's the same idea on the confirm down. You buy proactively. We went out and we bought the put. Now SPY is trading at 296. We pay $14 per share. At expiration, that same value now on that put is $67 per share. And again, even if you sold it anywhere in this area here, you're profiting and mitigating losses. Okay. And Robert, this we're buying the puts on the SPY. The graph I showed earlier was the SPX, which is the actual S&P 500 index. So we're buying the puts on the SPY, which tracks the S&P 500. Okay, so remember I showed this earlier. This is the equity curve from earlier. So that drawdown is greatly mitigated. Maybe again, maybe not dollar for dollar, but we're proactive and we don't have to live through that catastrophe, suffer through the catastrophe that never had to happen. Okay, so I talked about the three core strategies. Growth portfolio, when we focused, we said we almost triple the return on the S&P 500 when we do that right. I focused on the power of a dividend growth portfolio as part one of generating a steady income, and we had over 20% when you include the dividends without even counting for compounding. I talked about the power of covered calls with just one example. An 83% success rate in our retirement income portfolio, generating about a 15% return this year, just doing one trade a week. And then only when the market is favorable. I talked about preserving capital in individual stocks and showed you the power of buying an insurance policy on an asset in case it's damaged. And then finally, we walked through both the DEW and the confirmed down call and how an insurance policy can work for an entire position. Okay. Those three core strategies that every retiree must know to grow their portfolio, generate income, and preserve their net worth. It all comes back and it was all created under the conversation I had with Dr. D. The ultimate retirement solution says just keep making more money. Okay. So with that goal in mind, what I'd like to do is invite you to stay with me for just a couple of more minutes so I can tell you about the Ultimate Retirement Solution online course, Protect and Grow Your Retirement Nest Egg and Your Net Worth. Okay. The online course is designed to take you by the hand and guide you through the method that you need to grow and protect your retirement portfolio. Let me just briefly talk about the 6 modules. These are the lessons that are involved, by the way, which you get access to for a full year, and all of the resources that I'm going to tell you about, you get access to for a full year. So we break it down in modules and we go step by step. We talk about setting goals and objectives. You cannot be successful if you don't have the time to sit down and write exactly what I'm looking to accomplish. So we talk about that in Module 1. In Module 2, we'll walk through buying the right stocks at the right time. The checklist that I talked about, balancing your portfolio, and setting up that specific plan that allowed us the results I showed in ruler stocks. In Module 3, we'll shift gears a little bit and we'll talk about building a dividend growth portfolio. The characteristics of these stocks are a little bit different, so we'll identify the quality dividend growth and again set up that plan for that. Modules 4 and 5, we'll talk about options and we'll teach you the what, when, and how, the proper setup and trade management of the covered call. There's a very specific process we go through. We do that in Module 4. We also do it in Module 6 with the trading plan for what we call the retirement income portfolio. And in Module 5, again, we'll learn how to identify those defensive signals and understand how to protect individual positions as well as an overall portfolio. Remember back in the 80s, it was the Strategic Defense Initiative. That's kind of where I got this from, Strategic Defense System. Right? And like I said, we'll then talk about implementing the plan. The Ultimate Retirement Solution online course offers these modules, but we offer a whole lot more resources to go along with that. Number one, as a bonus, you get 6 live mastery support sessions. So those modules are in the university.vectorvest.com. So in the VectorVest University, you access the recordings of the modules. And then we're going to have a live mastery session each week pertaining to that module so we can help you implement what you learned. If you can't make it, don't worry. Everything, the recording of the live module later that day will be archived in the digital course. So there's 6 live mastery sets, another hour, hour and a half on top of the module to make sure we're all on the same page. Now, here's my favorite thing that I do here at VectorVest. We have our 6 weeks access to the retirement coaching group is the bonus you get for signing up for the course. We have portfolios that we track each week. We do due diligence. Do we have earnings coming up? What's the overall market doing? Let's just sell some covered calls against stocks we own to generate income. Okay, we just walk through a dividend growth portfolio, a ruler stock portfolio, the retirement income portfolio. If the markets are in our favor, we'll go ahead and actually place a trade each week. There's another bonus module that comes at the end of the 6 sessions. My friend and colleague, Mr. Ron Wheeler, who is as good as anyone in doing this, will teach you how to trade spreads, credit spreads for monthly income. So this is option oriented and it is a bonus module, but it shows you the power of trading credit spreads, and they're very high probability trades and you can open up another income stream. So we'll introduce you to that as well. If you're in the room here and you are not a current subscriber to VectorVest, we're going to give you 60 days access to VectorVest intraday if you come and join us for the course. Best tool I know of to determine market direction and find stocks and help you reduce the time it takes to do this. The total value of those bonuses I just went through, you got the retirement training course, you got the mastery sessions. If you're new to VectorVest, you get the 60 days. We have the bonus module, and then again we have 60 days access for 6 weeks. Every Tuesday you'll be invited to the retirement coaching group. Okay, so that constitutes the URS online course that you have access to for a year and all of the resources that go with it. Okay, the regular price on that is $9.95. Okay, what we call the early bird price, special pricing until August 25th, is $5.95. But because you guys were kind enough to join me here today, what we're going to do is give you what we call the fast action bonus, and you can order before the end of the webinar today. And we'll go ahead and sign you up for the course for just $495. Okay, you can go to this link. It's a www.vectorvest.com. And my colleague John in the background has typed it into the chat box. You could just click on that link, www.vectorvest.com/URS. And I'll go to the site in just a second to show you what it looks like and make sure you can get there. But again, we'll give you that special price of $495. I'm going to stay with John. We're going to answer some questions, anything about what I talked about here today, or about the course, anything you want to talk about. So that $495 will be good for a little while. They say in the market that there is I say in the market there is no such thing as a risk-free trade. You can't ever hit the enter button and have a risk-free trade. There's always going to be risk, except for this trade, right? For this course, because after the course is over, if you show you've done the work and done the assignments and logged in at least to the university, and you're not satisfied, we will gladly give you a refund. We'll gladly give you a refund for the course. That's how confident we are. You'll walk away feeling more confident in your ability to build and manage your retirement portfolio. Okay. The question I ask, and more importantly you should ask yourself, is how much is it costing you not to do this? You guys came here for a reason today, I think. Right? What will it cost you if you do nothing? How much money might you lose? How much potential profit might you miss out on? How much time and energy will you spend trying to do this on your own without a plan laid out for you? And then ask yourself, you know what, if I do this and it works, how might that make life a bit different for me? It's not too late. They say that the best time to plant an oak tree is 20 years ago, so you can sit under the shade today. And we all know when the next best time is, of course, it is today. So it's never too late to begin to prepare yourself for retirement. Again, the regular price is $9.95. $5.95 will be the price if you don't take advantage of our $4.95 uh, fast action bonus. John put the link in. You could click on it right there in the chat box, or you could just type in www.vectorvest.com/URS to take advantage of that price. Someone I think I saw typed in, when does it start? Here's kind of how it works, and then I'll bring John in to let me know if there's any questions I missed that have been popping in here. If you sign up today for the 495 or whenever you sign up, you will receive instant access. Well, instant. It takes a little bit, but you'll get an email shortly after you sign up with all of the instructions you need to access the online digital course. Those 6 modules that I showed you are the lessons. You'll have access to all 6 of those for a full year. The mastery sessions begin on August 31st. They're going to be every Monday, except the 8th because that's Labor Day, so we're going to push it to Tuesday. And these are at noon Eastern Time. Monday, again, that's the only exception to Tuesday, but every Monday at noon Eastern Time, including the bonus session I talked about that Ron will do. These will be recorded and archived in our in the university.vectorvest.com. So if you can't make the live version, you will be able to see that later that afternoon or evening. Okay, so those are the dates. The actual course you'll have access to once you sign up. And the mastery sessions are these dates. And I'm sorry, I didn't put 12. I should have put the time on here. 12 noon Eastern Time. 12 noon Eastern Time. Every Monday except for the 8th because it's Labor Day. Okay. I see. I was just going to ask if you've signed up, if you've gone there and you've logged in, let me know. Just type in that you're in. And Shun beat me to it already. He said he just signed up. He said, thanks for the worry-free investment course I mentioned last time and look forward to learn more from this course. Great, Shun. Thank you. Look forward to seeing you there as well. I think there's some great stuff here that you'll walk away with. Okay. All right. Well, with that, I'm going to go ahead and take any and all questions that you guys have, like I said, about the course or about what any other questions that you might have about what we went over here.
Hey, Jim.
All right. So maybe I'll ask John to come in. Like I said, it's hard to watch every question that comes in. John, thank you for answering those questions in the background. Is there anything you see that I might have missed that I can comment on here?
Yeah, would you show them again how to mock enter the order following the links, what you need to do?
Actually, I see Warren. So I see before John comes in, asks if I'm signed up. Warren, here's what you have to do to sign up. Okay. I'm gonna bring my page over to here. So I have to go to www.vectorvest.com/URS. Okay, and when I do that, it brings me to this page. Okay, I can scroll down here and I can get a good overview of what we do and a lot of what I just talked about. Okay, we'll even give you a chat box there where we got folks helping you out there. Okay, you'll see enroll today. That's the special price there. That'll last for about another half hour, probably at least. Choose purchase course now. And when you do that, it'll bring you to the product, the Ultimate Retirement Solution course. It'll say $495 here, and we'll ask you to proceed to checkout. If you are new to VectorVest, if you are not a current subscriber, then you will need to fill in your basic information here and choose submit. And it'll walk you right through the process. Very easy to do. If you are a current VectorVest subscriber, simply click sign in. It will ask you to put in your VectorVest username and password. And once my slow computer thinks it over, it will take me here to the actual product, and I just have to fill in my basic information and walk through the process. Okay. Now, if you're an elite member, I think I saw a question. I know it'll come in. If you're an elite member, remember the price of the course is $9.95. That's the list price. Elite members get 50% off that, so it would be $497.50 if you don't take advantage. See, I'm making money for you already. You're saving $2.50. Okay, I'm making you cash already. But you can do this anytime, by the way. And if you think about it and you discuss it or you decide you do want to take it, you have until Tuesday, August 25th is when the 595 price will kick up to 995. So even if you deliberate for a little bit and you still want to take the course, you can come in and still get it at the 595 early bird special. But because again, you guys were kind enough to take the time, you can save some money by signing up now. It's risk free because we'll give you your money back if you're not satisfied. Okay.
Hey, Jim.
So Warren, let me know how that went. That's how you'll get signed up. So let me know,
Hey, Jim.
and let's go ahead and take a look
Jim.
at some of the questions here. John, if you're there and you're not typing away, do you see anything? Uh, I see some flagged. I'll just start there. Anthony says, "Tell me more about the weekly URS sessions." Anthony, yeah, I'd be happy to. I don't have the portfolio open now, but we have portfolios that we track, and we also have them. I can't hear you, John. I don't know why. I think I am down. John, I'm sorry. I had my volume down. think I can hear you now.
Can you hear me now?
I can.
Okay. All right.
I'm sorry. Was I talking over you that whole time?
Yeah, I was trying to say stuff, but you couldn't
Ah,
hear me, but that's
jeez.
fine.
I'm sorry. Live entertainment, folks. I told you. Sorry about that, John. Sorry.
That's all right. Yeah, but you caught that first one from Anthony about the weekly sessions. We can go from there.
Okay, great. Yeah. So I just want to show you real quick what we do, a part of what we do. We do have portfolios that are created. I have the blue chip dividend portfolio. We have what we call a master portfolio. We do ruler stocks. Again, all of these are built on very specific trading plans and systems. Here's the portfolio I showed earlier. We have shorter term portfolios, and each week what we do is we go through. And we use Profit Locker Pro, by the way. So the Profit Locker Pro exit strategy that comes with the course. If you sign up, you'll have access to Profit Locker Pro and understand how we build our trading systems. Okay. So we go through those. I don't have it open, but I also have a Thinkorswim account where we go in and we do our buy rights or the covered calls, right? And again, I showed this earlier. This is a spreadsheet for this year for the retirement, what we call the retirement income portfolio, or what I call the RIP, right? Retire in peace. Okay. And you'll see we've done 18 round trip trades. We've made just about 8,500 bucks. These four trades are actually all profitable. This means they're open right now. Okay. We haven't used more than 50,000 in this account. Remember, you got to buy 100 shares of stock. You'll see they're all, good quality stocks. You'll recognize the names here. We keep the price under 100 bucks. We stick to our process. We buy either 100, 200, sometimes now and then we even go 300, and that's how we do that. So again, 15 out of 18 trades. We didn't do trades from uh, late February, of course, right up until what was the first trade we did after the big sell-off was Ross Stores on the 7th. This Teradyne was a position that never should have been left open, but it was left open during the sell-off. And that was my mistake. So there was a lot. So one of the losses was because I was a knucklehead. But we did have three losing trades. That was one of them. But right after the sell-off and the market began uh, rebounding, we started trading again, and we've only had uh, two losing trades since. One small one here and another 548. But uh, it's been a nice run on this. Like I said, we've never had more than 4 or 5 positions at any one time. So you're roughly putting about 50 grand in, which is roughly a 15% return on investment that we've had. So that's what we do in the Tuesday sessions. We manage our portfolios. We fill spots when it's time. We mitigate. We walk through those SPY trades, and I'll place those trades live to show you how. Okay.
Okay. Next question is from Anthony, who's essentially he's in Canada and he's asking if this would work for him in Canada.
Yeah, Anthony, thanks for the question. Yeah, a lot of folks, whether we have Australia, UK, Canada, and other uh, countries. But yeah, the short answer, Anthony, is this. I believe it does. I believe that the concepts of buying good quality stocks at the right time for capital appreciation, for finding the proper dividend growth stocks, the concepts are the same. The process in the VectorVest program is the same. But to be honest, where there is a little bit of a difference is when it does come to the covered calls and the option part of this. The option markets in most of the other foreign markets from the US are not as liquid. And quite frankly, it's not as easy to place the trades as it is on the US side. You can do it. You can do it. It might just take a little more effort to find, but you can find good quality stocks for dividends. You can find great growth stocks in the VectorVest program, regardless of the database you're in. Okay, and you can use the option side of it. It's just not always as easy or as liquid. So hopefully that helps a bit.
He said can you study at your own pace? He said his pace is a little bit slow.
Yeah, the great thing is that you can go, like I said, when you sign up for the course, when you come in here and sign up, okay, you will get, oh, what am I doing? You will get access to the course, right? It takes a little while, but oh, I don't know what's going on there. It takes a little while, but you will get an email very shortly after you sign up, and it will give you the instructions to access the course. Those 6 modules that I talked about way back here will be available to you. There are other resources as well. There are video resources. There's kind of what we call homework assignments and video resources that go with that. There is all of the slides from each presentation are there. So you have access to all of these right out of the gate. And then the mastery sessions, like, so there's one in there now, right? If you sign up now and go in for module 1 and module 2 right on through, there are mastery sessions, but those are from the last course. But as soon as we record the new ones, we replace it. So you'll have the new mastery session. So you can go through these, and remember, if your pace, whatever your pace is, you have access to all of this for 1 full year. It's not just, you get it for the 6 weeks and it disappears on you. You have access to it for a full year. And the 6 Tuesday sessions, by the way, are also recorded and placed into the digital course so that if you can't make the live Tuesday sessions, you'll get it that night and be able to, or that afternoon or evening, and watch it then. Okay. So whether you're quicker or slower here, you have access for a year and you're ready to go. All right. All right. What's next here? Oh, Greg says he purchased from Australia. Greg has just purchased. Thank you, Greg. I look forward to seeing you in the sessions. Thanks for signing up. Yeah, keep an eye out for the email. It'll come to you again with all the instructions you need to get logged in and ready to go. Great. Carl also just typed in that he's in. Fantastic, Carl. Keep an eye out for that email. If there's any issues, of course, make sure you call product support. But it's all pretty straightforward. Once that email comes to you, you'll have the access to it, and you'll be ready to go. Robert says he's in the options paycheck course. Do you suggest taking this course later? Robert, I think this is the best course we offer, and it's much better than the options. No, I'm just joking. That's a joke. I'm joking. Robert, if you're in the options paycheck, listen, I'd love to have you in our course. There's nobody better than Ron teaching, credit spreads and how to generate income. It's hard for me to say, enjoy the options paycheck, do the work there, and maybe we'll see you at the next iteration of our retirement course. That might be best for you. as much as I'd love to have you here. It was a joke I made originally, so you guys know. Carl, again, thank you for signing in, and again, we look forward to it. We think I really believe that these three core strategies are, in some circumstances, they seem pretty basic and straightforward, but there's a discipline and there is a process, right? You have to have a process behind all of these things. Otherwise, the management side of all of this gets tossed, and uh, it can cost you. It can cost you. Anthony says, "Is the 495 just in the next 30 minutes or so?" Anthony, yeah, you're going to see the 495. I would say for at least the next 30 minutes. Um, so you may want to take advantage of that. It may be a little longer. You can check, and you'll know when you go. It's the same link. When you go there, that price will change, but at least the next half hour or so, you'll have that 495 there. Shake, if I'm saying your name right, Shake, perhaps. What should be the minimum cash layout for the URS? Yeah, that's always a tough question for the retirement side of all this, because that number can vary. It's not like an options course where the beauty of options, of course, is the leverage that you get. So you can start an options portfolio with anywhere 5 or 10 grand. You can do that. It's a little different here. Remember, we're buying growth stocks. We're looking at dividend stocks. Does that mean you need a $500,000 or $2 million to do this? Of course not. That just that buy right portfolio alone, like I said, we never used more than 50,000 there. If you've got less than that, you still want to be able, if you're looking at the long term. Again, remember, this isn't a trading course. We're not putting up intraday graphs with 2-minute bars. That's not what we're going to be doing. So, it really is. It's a tough question to answer because it's all relative, right? A $10,000 account or $1 million account, to whoever it is, it's your money, and you've got to invest it wisely. And I think there's things you can certainly take away here with a smaller portfolio and the ability to grow it. So, very tough question to answer, though.
Hey, Jim.
Yes.
Question from Ken,
Hmm.
just to clarify what level of VectorVest that they'll actually get, the tool itself.
Yeah. Yep. Great question, Ken. What you get, if you're not a member, sign up, and we're going to give you the intraday program. The intraday Vector Vest is just delayed quotes. It's live streaming throughout the course of the day. The only difference is, I guess you put live in parentheses, I suppose. It's 15-minute delay. So if you're in Eastern time at 9:45 in the morning, VectorVest intraday begins to stream, right? And you'll see the changes, keeping in mind, of course, it's a 15-minute delay. Now, good question, because there are also other things you get that I haven't mentioned. You get access to Profit Locker Pro, which is on an annual basis $1,000 a year. You're going to get access to the Profit Locker Pro to determine if that's something you want. You get Auto Timer. You get what else do we get? Pro Trader, I think.
Pro Trader,
Yeah,
yes.
Pro
Pro
Trader as well.
Trader,
So
yeah.
those come with the bundle there as well, along with the course. So you're also going to get access to trading systems within the VectorVest program. Okay, so if I go to VectorVest and I go to, let's say I go to portfolios and I want to create a new portfolio. Now let's use backtest instead. So I want to go to back and I want to create some. But either way, I'm looking to use an existing trading system. We have what's called the VectorVest trading system viewer here. And I usually sort them by market timing because remember I just talked about the blue chip dividend portfolio. Well, here's the trading system. Now you only get access to that if you take the URS course. So you wouldn't have access to that right now. But you could build a portfolio or create backtests, whatever, and you'll have access to those trading systems those templates once you join the course. Okay. here. See if I think anything else. So to those who typed I'm in, again, thank you. I'm just going to kind of pause here for another few seconds. There's still some folks in the room. If you have questions, if you're trying to log in and are having any issues, let us know. I'm going to give you another minute or so because once I'm off here, I'm going to go record tonight's daily color guard report. So if you haven't had enough of my voice for the last hour and a half, you tune into VectorVest and you'll get me on the daily color guard report tonight as well. Thank you, Carl. Thanks again, and you have a good evening as well. Stay safe. Ken says we get it for 60 days. Then must we buy VectorVest? Yes, Ken. We order you. You have to. You are forced to buy VectorVest after the 60 day. No, I'm just kidding. That's a joke, Ken. No, of course you don't. We want you to come in, experience VectorVest if you haven't before. It's a great tool. It puts us all on the same page during the course. That's why we offer it to folks who are not current subscribers. Our hope, of course, is that during the course you'll see the power and the value of VectorVest. But no, you certainly don't need to own VectorVest once it's over. We think you'll want to. We think that you'll want to, but you don't need it. Neil, what kind of trouble are you having with the link there, Neil? Did you just click right on the one that's in the chat box, or did you make sure you type in www.vectorvest.com/urs, and it should bring you there. And Richard, thank you. Okay, and then so what's the problem, Neil, that you're having then? Robert, you do not need access to Options Pro. In our Tuesday sessions, I do use Options Pro when we do our buy right trades. We do our weekly income trade, but that's part of the deal. I do it for you in Options Pro every Tuesday. But again, Options Pro is a wonderful software, and I think you'd benefit by having it. But no, the answer is you don't actually need it. So for Neil, type in www.vectorvest.com/urs. If you say you're having issues, I'm not sure, Neil. When I click on the link to purchase, it goes to payment page with no options. John, I'm not sure what that means.
Me either. I don't know that that's possible from this. It defaults to the payment
Yeah,
page,
so if you're clicking that,
regardless of which version
yeah,
you're using.
if you're using the purchase now, this is what should come up. So this is, do you see the proceed to checkout, Neil? Do you get to this page? Kobe, while Neil's trying to, okay. John, maybe we'll put the product support number in. Maybe Neil can call for that. Maybe we'll type the number in there for him. Kobe, while we're doing that, and while we take a few more, a minute or another minute or two for any other questions. Kobe says, when you buy a put for the spider at money, for how many days out do you buy the put? 10, 20, 30 days? Kobe, I'll usually go to somewhere between 30 and 45 days, which gives me time to evaluate the market. In other words, we get a confirmed down or a DEW down. I personally usually only use the monthly expirations. So today is 8/20, right? Tomorrow is actually expiration day on the monthlies. I would probably go out now if I were looking to protect my portfolio and simply buy the September expiration date. Could I go out a little bit further? Maybe 45 days? Sure. Um, but that's usually my window, 30 to 45 days. Okay. All right, Greg. Thanks. Yeah, 4 a.m. Australia time. Yeah. I like to do whatever I can for our customers and clients and students, but changing timelines and the time space continuum is one thing I can't quite do there, Greg. Sorry. I've tried. I tried doing it, but it's hard to do. But yeah, as John wrote in, remember they are recorded for you. So, all right. All right, folks. Well, again, thanks for taking the time. I'm going to go ahead and wrap it up here. You can always call product support if you have any questions. Thank you for taking the time, and I hope to see you again. That link that we put up there is good until right up until I believe the 26th, which is next Wednesday. So even if you didn't sign up today and you're debating it or deliberating over it, go ahead and you still have time to sign up, and I look forward to seeing you there. So, in the meantime, stay safe, stay healthy, and we look forward to seeing you on our next episode. Thanks, everyone. Bye for now.